Hey guys, Rafi here from the Endgame Investor with this week's Silver Report. And today I'm going to give a detailed plumbing situation, what is going on in the recesses, in the dark dungeons, in the bottom of the monetary system. The mainstream media is starting to get nervous about what is going to happen when the debt ceiling is raised. And for good reason, Bloomberg has put 3 articles out on it in the past 3 days. Relentless silver flows continue into New York. They have not stopped nor abated. The gold to S&P 500 ratio is at a trend line established in 2011 at the gold top. The ratio is higher than it was back then, meaning we have a lot lower to go. Lower means lower stocks, higher gold. You'll see this ratio going back to 2011. It's pretty fascinating. And also the silver to S&P 500, actually the S&P 500 to silver ratio is also at a trend line established in 2011. Interesting how these things line up. The first thing I wanted to go into today is the plumbing situation, and we see that we have 2 Bloomberg articles here back to back by my favorite plumbing author at Bloomberg, and that is Alex Harris. First, she says on March 19th, Fed to shrink balance sheet at slower pace until debt ceiling deal reached. I have one paragraph boxed in a red rectangle at the bottom here, and I want to explain that graphically. So we have here the first article. Officials who left interest rates unchanged on Wednesday said they'll lower the cap on how much in treasuries is allowed to mature without being reinvested to $5 billion from $25 billion. So we're cutting the rate of QT, of quantitative tightening, by 80% down to $5 billion. That is almost nothing. So they're getting really nervous here that QT is going to cause some kind of a conflagration. The longer it takes Congress to either suspend or lift the limit, the more cash that will make its way back into the financial system. That has the potential to artificially boost reserves, currently 3.46 trillion, masking money market signals that could indicate when is the right time to stop QT. So that is mostly an informative tone, and you'll see these articles get more worrisome and worrisome as we go on. This was March 19th. The next one is March 20th, and I'm going to explain graphically why more money makes it into the financial system the longer it takes them to raise the debt ceiling. You'll see that in the graph in the next 2 slides. Next article here, we see Wall Street uncertain over when Fed's balance sheet unwind will end. First paragraph is the most important. It's the one with the red rectangle around it. Lawmakers are attempting to strike a deal on the debt ceiling, the statutory limit for outstanding Treasury debt. The U.S. hit that limit in January. The longer it takes Congress to either suspend or lift the limit, the more cash will make its way back into the financial system. That has the potential to artificially boost reserves, meaning bank reserves, currently 3.46 trillion, which would make it hard to read the signs in the money markets that would indicate the proper timing for ending QT. Well, the reason that bank reserves are so important is because they fund the overnight repos that happen every night, and they are now between 2.3 and 2.5 trillion every night. And once about 83 to 85% of them are taken up by repos every night, then you have a repocalypse, which is what happened in 2019. This is why this is so important. So you'll see in the next article, the tone gets even more alarming. And this one isn't by Alex Harris. It's by, you guessed it, Chris Anstey. The Federal Reserve's decision to dramatically slow down the shrinkage of its U.S. Treasury holdings amounts to a worrying signal about market demand for longer-term federal debt. This is Summers' quote, and he's very worried here. He says, "This should be getting people's attention as an alarming development." Summers said in an interview on Bloomberg Television's Wall Street Week with David Weston. The move indicated that Fed policymakers determined there was limited absorption capacity in the markets for long-term bonds. The Fed on Wednesday slashed its cap for how much in treasuries it lets roll off its balance sheet every month to $5 billion from $25 billion. Again, that's the reference to the 80% slowdown in the rate of QT. So this is an alarming development. It is alarming. Right at the gold to S&P 500 trend line. This is fascinating. You can see here that 2011, right, the gold to silver ratio has gone up since 2011, obviously. As we all know, 2011, this is the September 2011 gold high. And we are now at 1.86, which is much higher than this high, meaning that gold is still much lower relative to stocks as it was in 2011. So gold in real terms was doing much better relative to a stock portfolio in 2011 than it is now. But we are at this long-term 10, 12, 13-year trend line, which hit here. It was established here in 2011. It was hit here during the March 2020 crisis. And yes, gold was going down, but it was going down a lot less relative to stocks, which were crashing entirely. And here we see we are tagging that trend line again. Once this trend line breaks, I think this ratio is going to make a run for it down, which means that gold is going up relative to stocks. It doesn't necessarily mean that gold is going up in dollar value, but it means that that gold is going up relative to the S&P 500. And when people notice this, it means that a lot of portfolio managers are going to cycle out of equities and move into gold to try to match those gains. And now, interestingly, you see the same thing with the silver to S&P 500 ratio. Even though the gold to silver ratio has risen, meaning silver has fallen in value relative to gold since 2011 for sure, we still see the same trend line here. Since 2011, since September 2011, the same trend line. It was hit in March 2020. I think this is actually August 2020, so it's slightly different. This is when silver started to really jump higher around July, August, when silver deliveries were at records. We're hitting that trend line again right here. When this trend line breaks, I think the silver to S&P 500 ratio is really going to descend, and that means that silver is going to outperform stocks handily. It's already on the way to doing that. And now if we look at the historical chart, we can see here, interestingly, that silver didn't start outperforming the S&P until 1931. Why was that? Because the deflationary process finished in 1931. After deflation was over, silver couldn't go down any more than it already had. And that is when stocks continued to fall, but silver, money itself, held its value after that quick deflation after the 1929 crash. And we see here that silver only outperforms after the deflationary process is finished. But this time there's going to be no deflationary process because the Fed is going to print trillions of dollars immediately when there is banking trouble. So I don't expect silver to fall after stocks peak as it did here. I expect silver to just go up. So we can see here that this is the same trend line that we saw in the previous slide. It is being broken, and you can see how steep it is from here. When this trend line breaks, the silver to S&P 500 ratio is going to fall, and silver is going to greatly outperform S&P 500 and other stock ratios. The banksters can't borrow PSLV. Remember, PSLV is being shorted. There's a record amount of shares short on PSLV. Why are they doing this? What benefit does it have for them? He says the banksters can't borrow PSLV shares to redeem for physical. So they're not using PSLV to get physical for themselves. They can do this with SLV. They cannot do this with PSLV. So the banksters shorted PSLV to prevent PSLV from buying new physical silver for its inventory, because if PSLV needs new silver for its inventory, that increases silver demand even more and pushes the silver price even higher. How does it work? PSLV only adds new physical silver when the net buying of its shares are positive. Shorting simply means borrowing PSLV shares from others to sell now. The banksters have to buy back the PSLV shares to return if PSLV shares rise and their liquidity is wiped out. Margin call and short squeeze. So it definitely is a potential for a short squeeze on PSLV here by all the banksters who are borrowing the shares to sell them to keep PSLV from stacking more silver, as it must do if there is net buying, which they are stopping by shorting. The more selling pressure via bankster shorts now means that even if there are more buyers of PSLV shares now, the net buying is probably flat or negative. This means that PSLV cannot add new physical silver to its inventory. Thus, the banksters achieve their goal of suppressing PSLV physical silver demand. The banksters are running out of room here. There's only a short amount of time, I don't know how long, until something blows up. We've got trend lines tagged from 2011. We've got silver flooding the COMEX. Something big is coming down the pike, and you've got to be positioned and ready for it. All that we know for sure is that gold and silver are money, and we will go back to them when the dollar is no more. And these are the symptoms or the warning signs that that is about to happen.